Well, good afternoon. My name is John Grady. I'm the Executive Director of ADISA. I want to welcome you to a webinar focusing on a new White House executive order and the whole subject of private assets in 401k plans. I'm joined by two terrific experts today, David Kaleda from Evershed Sutherland and Mike Underhill, who runs Capital Innovations and sub-advises the Cantor Fitzgerald Infrastructure Fund. I'm going to give them a chance to talk a little bit more about their background as we go, but I wanted to just kind of kick things off by saying there's been a lot of attention paid to what came out of the White House earlier in the year. And what I'd like to do, Mike, is just have you give us a sense what's in that executive order. What essentially did it tell the marketplace the White House is interested in having occur?
Pleasure being here and joining everyone today. I think when you look at just last month, August of 25, President Trump signed an executive order effectively democratizing access to alternative assets for 401k investors. And the executive order, it directs key agencies to re-examine and revise guidance that has historically restricted private asset access by defined contribution plans. It's a start. By no means is this a law. It's merely an executive order trying to facilitate a broader dialogue and education and pulling more people around the table so we can have a more fulsome discussion about the benefits of alternative assets within defined contribution plans.
Mike, before we turn to David, I just want to get your sense. Is this, would you say, a positive development for those who sponsor or those who are looking to have greater exposure in their retirement savings to private assets?
Oh, when we look at the defined contribution marketplace, multi-trillion-dollar marketplace, you have multiple types, sectors within defined contributions plans. So think about corporate 401k plans, government 457A plans, 403B plans. So you've got large institutions, think state, county, municipal, public pension funds. They provide defined contribution plans, small, medium, and large corporations. And think about, if you will, a state plan at the, let's say, California Public Employees Retirement System. They have access to alternatives through their defined benefit plan, private equity, private credit, private real estate, private infrastructure. Now think about those defined benefit plan participants as they're offered a defined contribution plan seeking to mirror their exposure in alts in which they've had access and benefit from alternative investments in the defined benefit plan. Now with a defined contribution plan, they could potentially have those same benefits of alternative investments. So meaningful, large marketplace, a wealth of opportunity for the fund managers, packaged product sponsors that can get in and learn more about how the defined contribution plan marketplace works, the people that are involved, the process and the regulatory framework, which is quite different than the wealth management marketplace, as well as all of the parties that are involved, the institutional investment consultants, the record keepers, some of the fund menu design and plan design architects that are involved in these defined contribution plans.
Thanks, Mike. That's really helpful. And we're going to be coming back to a number of the issues that you touched on in your response. Now, David, if you wouldn't mind, provide a little bit of information, if you would, on your own background and expertise, and then pivot to the real question at hand, which is what did that executive order do, particularly from an ERISA standpoint? And just as importantly, what did it not do?
Thanks, John. My name is Dave Kaleda, and I'm a partner at Evershed Sutherland, and I've been practicing the ERISA space, particularly around investment management and similar issues, since 1996. So I've been doing this a while. And, I think this executive order is particularly helpful to plan sponsors, particularly ERISA covered plan sponsors who want to include these types of investments in their plans. There's nothing in ERISA that's ever said that you can't have these kinds of investments in plans. And in fact, there are some investments that do, some alternative assets that are in plans these days, or investment funds in which plans invest, i.e. real estate and private equity. I think there's always been this reluctance associated because there's no stated policy by the government and more specifically, the Department of Labor, that these are okay, and that it goes beyond just real estate and private equity. So this is definitely a step in the right direction. And I think it will have the effect of the Department of Labor earnestly looking at regulatory solutions, preferably safe harbors, but at least other kinds of guidance that will encourage or get plan sponsors comfortable with the idea of investing in these asset classes, either directly or indirectly. But what it doesn't do, it's not law. I mean, I can't use this as, to defend myself in an ERISA litigation lawsuit. Really, it's just the stated policy that we think will result in positive guidance from the Department of Labor that will be helpful in the event of litigation. But to be clear, it's not law, and it doesn't necessarily stop you from being sued under ERISA, which is a statutory provision within ERISA.
Thank you. I want to come back to something that you, in a sense, put at the center of your remarks. You talked about plan sponsors and, to an extent, the fiduciaries who operate plans for the benefit of beneficiaries. Can you talk to us a little bit about why this is all going to focus, or at least in large part focus, on sponsors and the individuals who serve as fiduciaries? How does ERISA place that emphasis on the actions of these folks? And Mike, if you would supplement David's notes on then who are some of the other players in that mix that you find yourself talking to when you're approaching the plan fiduciaries with an investment product or an investment idea. So Dave, if you don't mind.
Yeah, so plan sponsors and we're the fiduciaries who are ultimately responsible on behalf of the plan sponsor to make investment selections within the 401k plan. In other words, determine what funds, investment funds should be available. They're operating under this very strict ERISA fiduciary standard, which amongst other things requires the duty of prudence, which is a prudent expert standpoint. So they need to make decisions as if they were experts in investment selection, a duty of loyalty. They have to act strictly on behalf of the plan participants and beneficiaries, and they cannot consider the interests of the plan sponsor in making those decisions. There's a duty to diversify plan assets, as well as a duty to plan governing documents. If you breach your fiduciary duty, you can be sued either by plan participants and beneficiaries, the Department of Labor, or even another fiduciary in order to recover losses on behalf of the plan in the event of a breach of fiduciary duty. So it's very important that they follow these. The good news is that even though there's a prudent expert standard, you don't necessarily have to be an investment expert yourself. You can hire a third-party investment consultant, which many plan fiduciaries do, in order to enable you to make those or help you make those decisions on an informed and expert basis. And the other thing is, ERISA is really driven, it's what I like to call, it's about procedural prudence or process. It's more about the process that you engage in making investment selections rather than the outcome of those investment decisions, meaning the performance. In other words, just because an investment option doesn't perform well doesn't necessarily mean that you violated ERISA. If at the time you make that decision, it was appropriate and prudent to make that investment decision, that should win the day, and it often does in court. So that's it really comes down to is really just making sure that you have your ducks in a row when you make investment decisions, including decisions to invest in alternative assets. And that's not new to ERISA.
Mike, I don't think any of us think that plan fiduciaries do everything without a little help. Why don't you talk about the kind of help that a lot of plan fiduciaries and sponsors bring into the game in order to help them make these defensible, process-driven decisions?
When we look at the defined contribution plan marketplace, in some cases, 98% of the time, there's an institutional investment consultant that's in charge of overseeing design, portfolio construction, menu selection of investment options. And I think that type of institutional process, to David's point, there are fiduciaries involved. The institutional investment consultant is overseeing the investment menu construction, which is not something that takes days or weeks. Typically, this is months. And sometimes when you look at that process, there are RFP, requests for proposals, that are involved in the menu selection just for investment. So think about that layer of complexity and institutional process, as well as board meetings. And if you're in the public sector, sometimes the board meetings take place monthly, maybe quarterly. So there's a longer, slower process. And the best analogy I could use is this is a marathon. It's not a sprint. So I think with the institutional investment consultants that are involved in the process and the program design, menu selection, and design options around investments, alternative investments will become part of the menu in the future. But I think even taking a step back, education is going to be paramount importance when we look at incorporating alternative investments within these menu selections. Why alternative investments, diversification, alternative income, and all of those other things. And I think product structure that's really the first mover advantage. When you look at these defined contribution plans, the institutional investment consultants that are involved, the working thesis on this is that pooled products with liquidity will be the products with first mover advantage. And I think when you just look at the transparency, daily pricing, periodic liquidity, that's where you're going to see interval funds having being on the starting block, having a lead position, pole position, if you will, in this race, combined with education and all of the different financial literacy components that need to be involved in what admittedly is going to be a long race.
Thanks, Mike. Interestingly, David, we've used the analogy of a starting gun and said that the executive order might be tantamount to the firing of that starting gun. From the regulatory standpoint, what do we see that might be on the menu of what's next? What would a regulatory agency in the position of the Department of Labor, which is kind of the subject matter of the order, what are its tools? What kind of approaches might it adopt? And then, Mike, I want to circle around and ask you, if that's the starting gun for the agencies, what does the starting gun mean to the issuer community? So, David, if you wouldn't mind starting.
Yeah, absolutely, John. Department of Labor is the primary regulator here because the focus of the order is on ERISA covered plans. And there are a number of tools. First of all, in order to make things happen, they need to get their Employee Benefit Security Administration, that the Assistant Secretary has to get confirmed. Mr. Aronowitz has been confirmed by the HELP Committee, which is the Health, Education, Labor, and Pensions Committee in the Senate. So he will be approved, but he still hasn't been put up for a vote. So my guess is they're not going to make any major regulatory policy type decisions until he is in place, but hopefully that will come very soon. There are a lot of different tools they have. The one that's the quickest is an advisory opinion, information letters, other kind of compliance assistance statements, things like that. Those are the types of guidance that can be issued relatively quickly and can kind of set the stage for what works under ERISA and how plan sponsors and other fiduciaries might approach their selection process in light of the policy underlying the executive order. So I think that would be more immediate. I will say they probably have the least amount of effect from a legal standpoint, especially in light of some recent Supreme Court cases. Regulations, as a general rule, are much more helpful in defense of positions taken under ERISA. So the extent that they can issue regulations, which will be stage 2, that will take a bit longer because there's a notice and comment period. A regulation can take easily 12 to 18 months before it's actually final. And then there would be a later effective date. So I think sub-regulatory guidance will be the first thing in that order, and then we'll see some regulations. There may also be some exemptions that would be particularly helpful around here, around collection of fees and things like that. And again, that's somewhere in the middle from a time frame. It's something that might take a year or so. It might take a little bit less than a regulation, but that is something they can do as well. But the key is hopefully Mr. Aronowitz gets in there soon so that we really can get the ball rolling. And I think to Mike's point about education of investment consultants, I think there's some education involved here too of the Department of Labor to get them to understand investment vehicles like the funds that your group works with and other kinds of investment options and how they work. So that will help them craft the best guidance, whether regulatory or sub-regulatory, that the industry can get, and then on which plan fiduciaries can rely.
Thanks, David. And before I turn to Mike on kind of what the industry can do with this starting gun going off, how does an agency like the Department of Labor get information from sort of that universe, whether it's sponsors, product providers, lawyers, trade associations, et cetera? Is there an official way that you've seen either in the past or that you expect would occur here for the public or for the experts or for the industry to get involved, to be part of that discussion in the first instance?
Yeah, in my experience, and I've done this a number of times on behalf of a lot of different clients, where they'll either go in individually or as groups. Either they'll form their own coalition or they'll rely on trade associations, organizations like this one, where they'll ask to meet with the Department of Labor. And they're very open to this, both the political staff as well as the career staff. And what you do is, I typically do, is you kind of lay out what you want to talk about and outline it in a discussion, what the group believes would be appropriate type of guidance, whether regulatory or otherwise. And then they'll also educate them on what the product is, how it works, or what their position is, why it's appropriate under ERISA. One thing, the Department of Labor, they're always going to be thinking of the interests of participants and beneficiaries. So you have to go in there with that mindset that really this is going to help them, and this is why. And why, you may have heard negative things or challenges or things like that to a particular product or strategy, but this is why it's appropriate and why the positives may outweigh the negatives.
So, Mike, before we kind of get to what can the industry do from a product development and product promotion and sort of product positioning standpoint, can you talk a little bit about this idea that there are folks along the political spectrum who have taken issue even before the order was issued with the idea that privates have a place in retirement portfolios at all, and some of the arguments that have been made at a sort of a macro level against really the heart of what this order is trying to put forward?
Well, I look at politics and investing, and it's quite the toxic cocktail, if you will. The ability for fiduciaries and plan sponsors and the participants all to interact and truly be educated and provide solutions in an ecosystem where the participants are seeking more information on alternative investments. The fund sponsors, alternative investment sponsors, are providing content. You have various politicians with various degrees of financial literacy and, unfortunately, financial illiteracy. And so I think for any of the politicians to opine on things, it sort of depends on who you're talking to. But I think when we take a step back at the macro level, there have been concerns around Peter Thiel having an IRA account that's worth $4 billion because of some of the alternative investments he's made within an IRA account. Those are some of the concerns. The other concerns about the potential to have either a negative outcome because of alternative investments. You can always find an example of, for one reason or another, an alternative investment that worked really well, and conversely one that has had a poor outcome, and then subsequently led to either litigation or investors being potentially harmed, things like that. I think whenever you politicize these types of investments, it gets away from the center of the discussion. The core of it is why invest in alternatives, the ability to provide not only inflation protected income, but capital appreciation that's uncorrelated to public markets. And whether you're talking public market equity or public market fixed income, the preponderance of the private companies in the United States, 63%, are private. And I think when we flesh out some of the details around that, whether you're looking at small, medium, or large, $1 billion plus revenue and above, 63% of the companies are private. So by not incorporating alternative investments, you're actually not providing an investment that could be potentially beneficial, regardless of an investor's socioeconomic strata, regardless of their accreditation. You have 10.6% of the population are accredited investors. The rest are within that sort of mass affluent or wealth management community. The benefits of alternative investments, I think, educating the politicians as to the benefits of alternative investments, but also the vehicle types and structure, typology, so they can better understand, have better financial literacy around alternative investments. So they better understand things like semi-liquid products that provide daily pricing and quarterly liquidity, something that can actually fit and be a congruent fit, which is a win for all parties.
It's a great answer. Mike. So I'm going to come back to you in a minute, but I want to ask David almost a rhetorical question. David, does the existence of the White House executive order end the political discussion over whether alternative investments, private investments generally, have a place in retirement portfolios, or does it just represent another voice in the overall discussion?
That's a great question. It certainly doesn't end the political discussion because that's just the nature of our country these days, right? Everything has become very politicized. But I think what's important is it does send a strong signal to the retirement plan marketplace that they're at least going to get backing from key regulators, particularly the Department of Labor, but possibly the SEC and maybe even Treasury and others as needed, or OCC. So I think it does give some folks some comfort, particularly those who might have been looking at this, much as Mike has described, about they see the advantage of these kinds of investments, but they weren't sure how to make it work. And if they can get more comfort with that and how to make it work, I think it will be helpful. What I will say, though, it has become very politicized. Like, I think people interpret this EO of saying that every plan participant can now buy an interest in a hedge fund or a private equity fund directly. That's what they'll own in their account. And that is not really what we're saying here. And I don't think the Department of Labor would agree that's necessarily the way we want to go, at least not for every participant. But really, it's an important part of a long-term investment strategy. So it doesn't make sense to preclude ERISA 401k plan investors from this opportunity to which others might get. Some folks in governmental plans, it depends. Some governmental plans, you can do this already, but others follow ERISA fairly carefully. So I think a change in the ERISA front will also open the door, as Mike suggested earlier, and also on the governmental space as well.
Thanks, Dave. That's really helpful because it helps me move to a point that I've been trying to get to with Mike, which is if it's a starting gun analogy and the executive order is the starting gun, what can the industry be doing, Mike, to kind of move forward? We've got a sense that the regulators might themselves be taking time to consider what resources to put into play, whether it's advisory opinions, exemptions, even changes to or new regulations to create a safe harbor, for example, for fiduciaries. But the industry is not, other than providing commentary and content of their own. I don't think the industry is going to want to be told, hey, just wait, and then at some point we'll tell you it's time to move forward in your own right. What kind of things can you see the industry starting to do to try and get as ready as it can be when the tools are in place at a regulatory level to move forward? And if there's anything that the SEC and the Treasury Department, both of which were sort of tagged with being helpful in the executive order, if there's anything that they might contribute to this, you can mention those points as well.
So when I look at the approach, the solution's somewhere in the middle, taking a multipolar approach, admittedly in a bipolar world, approaching from multiple points, vectors, where there's financial literacy around alternative investments, typology of investments, so think pooled accounts, daily pricing, quarterly liquidity, but also product features, benefits, function, and looking at the entire defined contribution 401k, but really defined contribution ecosystem to see how they can benefit from alternative investments as an option. Because I think David touched upon it. When you look at some of just the issues on the surface, there's a concern around traditional private equity funds with a 10-year lockup, or even hedge funds and opaque fee structures. Things like interval funds, they offer semi-liquid, regulated, scalable products that provide nearly full transparency at the fund level and at the underlying asset level, full transparency. And these could be beneficial to the retirement savers within defined contribution plans. So I think putting together a plan of action, organizing a working group to have a bit more of an organizational plan for financial literacy, i.e. educational products, understand plan design, understand the involvement of the institutional investment consultants and all the players within the ecosystem. So then we can actually prosecute the mandate of having an organized approach and a working group to deliver educational papers, as well as forums like this.
Thanks, Mike. Can you foresee kind of a rush of product development and the SEC taking potentially a role in helping speed up or at least simplify the process for new product design, development, and registration? Or is there going to be a focus on existing products and moving them to the forefront because of the known quantities that they already represent?
When we look at the interval fund market, the structure is not new, but I think what you've seen over the last 3 years is nothing short of stunning just in terms of product development, fund launches. Right now, there are north of 100 interval funds that are in phases of being launched in 2025. The ecosystem types of funds by asset class, private equity, private credit, private infrastructure, private real estate, and hybrid capital structure vehicles. The vehicles are being launched more frequently. The assets are growing fairly rapidly, so much so that now Morningstar has created a ranking system, database ranking system for interval funds. That's an effort to get ahead of the democratization of alts within defined contribution plans, because you all know Morningstar is used as one of the standards of ranking and analyzing fund product, package product for the defined contribution plan marketplace. And I think just look at some of what we've seen in the last year in terms of joint ventures and partnerships. Capital Group partnering with KKR, right? Formidable groups. Goldman Sachs partnering with T. Rowe Price to deliver alternatives. They see what's going on. So there's a movement afoot to launch new product, capitalizing on various hybrid capital structures and asset classes at the ground level. If you look at it at the macro level, there are these large firms that are striking JVs that if you asked me last year if T. Rowe would be partnering with Goldman Sachs on product for alternatives, I'd say that I wouldn't see that. And I have friends that work at Goldman, and sure enough, that was just announced 2 weeks ago. So I think there's a tectonic shift. And I think the collective consciousness in this industry, I've been around this industry for 33 years, the collective consciousness has pivoted to alternative investments, democratization. This executive order is just going to accelerate it. So I think getting out in front of it and working on education around product type, typology, structure, liquidity, product fit, and really taking a look at what's going on. I think it's accelerating faster today than I've ever seen anything in this industry.
Thanks, Mike. Dave, I wonder if you might take a step back and talk about the kinds of features and qualities an investment product might need to have to get the attention of either the institutional community that's gatekeeping or the plan fiduciaries in their own right who are looking at the marketplace and trying to decide from various parts of the market what to include when it comes to private asset vehicles. What are the elements that fiduciaries might emphasize? Mike's talked about some of the qualities that interval funds have, but if you could take a step back and say, the things that might really be important to the fiduciaries and to the institutional consulting firms that will be guiding them, what are those important qualities that you can, just based on what you're seeing out there, what you understand fiduciaries are typically looking at or asked to look at, what can you identify as some of the more important qualities?
Without a doubt, one of the big things they look at is they operate in a daily valuation type environment with the ability of plan participants to get to trade in and out of investments, usually T+1, although there's no requirement necessarily under ERISA to do it overnight, but sooner rather than later, the ability to redeem out, take distributions and things like that. So they definitely look for flexibility for the participants to be able to do that. I think one, because that's just how the industry has been operating for now at least a couple of decades, if not more. And I think it would be very challenging to try and get participants to accept anything less. But that doesn't necessarily mean you couldn't. It just would be a challenge. So I think the plan sponsors are going to look at this. The more seamless it is to a participant, the better. The other thing is that plan sponsors, and this goes to Mike's points about education, there is an education component or communication component with the plan's participants and beneficiaries as well. Because, well, one, most plans that have participant direct investments rely on the safe harbor under Section 404C of ERISA, which basically says that if you prudently select the investment options and then you communicate those well to the participants in accordance with a safe harbor regulation that's been around for decades now. If you do that, then the plan sponsor fiduciaries are not responsible for the investment decisions of the participant. So if they choose to put their money into one asset class and that one happens to lose the money during that time, you're not held responsible as the plan fiduciary. But what's a key to that is that you have to explain to the participants. So if there are restrictions on the ability to get in and out of an investment, you have to communicate those well. And the participants have to understand, because then if they come back and say, well, you never told me this, that is a way for them to proceed in ERISA litigation. But if you can show that, no, we communicated this and they understood those restrictions. And for example, we've certainly seen that in real estate, say in recent history, because of the change of the interest rate environment. There were a number of real estate funds that were either, say, insurance company pooled separate accounts or collective investment trusts, also known as CITs, that invested directly in real estate. And plan participants could invest in those. But because of some liquidity issues brought on by the new interest rate environment, there were restrictions on their ability to pull out their money at certain times. So they would put certain gates. So it's not unheard of to have those in place. So it could be the same for an interval fund as well. But the key is that you have to communicate them very well. And the plan sponsors are going to look to the service providers to help them with that. So that would be normally the record keepers. They tend to kind of take the lead on that. But to the extent that the investment community can also help them put together those types of materials, that would be wise as well. Because, in a sense, at least from a participant communication standpoint, the record keepers are somewhat like gatekeepers, even though they're ultimately not the fiduciaries responsible for those communications.
Great. I want to put this question to both of you, but Dave, I'm going to start with you. And in some ways, this is almost a threshold question, but I didn't want to put it on the table too soon. In terms of the kinds of ways, if you will, or means by which private assets can be added to the mix of returns that plan participants are exposed to with the okay and approval of their fiduciaries and any consultants, sort of what are those ways? I mean, are we talking about just putting more private assets inside otherwise open-end funds and letting them take advantage of their ability to hold illiquid assets? Or are we talking about vehicles that already exist that are a fit for private asset exposure because they hold private assets, or they hold assets like underlying funds that in turn hold private assets, or direct investment in private assets, either through a direct fund structure or even a direct investment? First of all, and Mike, I want you to talk about how the industry will see the same question. But for you, Dave, what are the ways that private assets can even be included in the range of options that participants might be shown in the coming weeks, months, and years?
Well, there's a number of different ways, and I've alluded to some of them, but one of them is there's an overarching investment fund, whether it's a CIT, pooled separate account, some other type of investment vehicle. It could be a registered fund as well, to the extent that they are invested in these asset classes. But they could either be a fund-of-fund structure where the fund invests in a number of funds that invest in a number of different kinds of investment classes, including an investment fund that invests in private equity or some other alternative asset. Another option is you could have, again, an overlying, let's just call it a master fund that has underlying separately managed accounts, and then they in turn invest in different strategies, and some of those might be alternate assets as well. A fund itself may be, if it's liquid enough, where that could be the investment vehicle itself. So it's liquid enough, it's diversified, you have the ability to get in and out, much like those real estate funds that I referred to earlier. Those are just collective investment trusts or pooled separate accounts offered by an insurance company, and they invest directly in real estate or an entity that ultimately invests in the real estate. But the point is that it's effectively getting access to that asset class much more directly than you normally would, unlike it wouldn't be like a mutual fund structure or something like that. So I think there's a number of different ways. And then depending on how it's structured, then you do have to coordinate, a lot of service providers have to work together. There's usually a record keeper, there's somebody providing valuation numbers, there's sometimes a middleware provider between the record keeper and the managers, or the CIT provider, or et cetera. So they all have to be able to work together, and that is important. So as you put together these products, you want to make sure that it's something that works within the technology structure that we've developed over the years, so that at least it works with the key record keepers out there in the marketplace, like the largest ones. That is certainly something I would consider as well, not just from a legal standpoint, just from a practical business standpoint. If you can't make it work, the plan sponsors will not adopt it, obviously, and the record keeper won't allow it to be on their platform either.
Great. That's really helpful thinking there. Mike, our industry, the alternative industry members that are part of the ADISA community, they tend not to be offering exchange traded products, but yet an exchange traded product could just load up on private assets and market itself to 401k plans as an entity that people can own to essentially access private assets. So from where you sit with the range of types of vehicles that are out there that can hold private assets, what are some of the considerations that would come into play if you're dealing with non-traded but partial liquid or partially liquid funds versus funds that just put all of the trading on an exchange and the liquidity is whatever the exchange offers?
Great question, John. So when I look at what it cuts to the heart of your question, instead of an exchange traded product, you're talking private placements, other, call it illiquid alternative investments. We have to take a step back and look at the alternative investment thesis and say, does it hold water? And really, what are the merits and what are the challenges? And I think so when you look at just the merits, there's fiduciary defensibility. In other words, what kind of transparent pricing, regulated redemption windows that will reduce litigation risk, as David talked about, because there is litigation risk depending upon the liquidity and the structure to fit in these 401k or defined contribution plans. Portfolio construction, accessibility. So think something like an interval fund under the 40 Act. No accreditation is necessary. Conversely, private placements, you have to have some form of accreditation depending upon structure and vehicle type. And beyond that, I think, I'll go back to the educational gap. The plan sponsors and participants, they need clarity on risks and liquidity constraints. There's also going to be fee scrutiny, higher costs, and the participants need clarity on the justification around higher fees and performance, net of fee performance. And then think about the operational complexity. Record keepers and platforms must adapt to the periodic redemption mechanics. They can do it with an interval fund, with private placements. It's a non-starter, if you will. And I think that's really, so typology, being able to purchase something on an exchange, QSIP ticker base through an interval fund, provides those types of vehicle structures. Those are the first mover advantage. Having a quarterly redemption window, that's something that is beneficial, but also that mechanism needs to be solved for at the plan sponsor level and at the record keeper level. That's still going to be a discussion that needs to take place, probably a little bit of a challenge. I think when you look at illiquid private placements, being included in some kind of a model, whether you're talking an exchange traded product, an ETF, or even an interval fund, inclusion in some of those types of listed products or sleeves, I think that's going to be the easiest path for an illiquid private placement to be incorporated within an exchange traded product, either ETF or interval fund, because those pooled vehicles are really that's the first wave of product that's going to benefit from democratization of alternatives, specifically in the defined contribution plan marketplace.
Thanks, Mike. And some of the points that you made caused me to want to ask Dave a few questions about whether those points are going to be ones that fiduciaries and their experts, their consultants that they are working with are going to struggle with. So one of the major political, but also typically fact-based criticisms of the alternative space is fees. Whether you just call it broadly speaking, there's a higher expense ratio typically associated with alternatives. There's also typically less liquidity. There's not typically an exchange, although products are going to be developed that offer both exchange trading and underlying assets that are private. But leaving aside for a moment that generation or iteration of products, there's often an illiquidity element to the envelope, to the account or fund that holds the assets itself. So are those going to be issues for fiduciaries when they're looking at including those types of assets in the 401k and similar menus?
Yeah, John, that's a great question, and they certainly are things that they'll be considering. Without a doubt, a lot of ERISA litigation is really focused on the amount of fees paid by the plan, either directly or indirectly. And the allegation always is that they're too high. But I think it's important to note, notwithstanding what the plaintiff's bar's position is in this litigation, is that there is nothing under ERISA that says that you can't pay more for an investment option if the benefits outweigh the costs. So if you can establish, or the plan sponsor can establish by vis-a-vis experts or however they're going to do it, that the increased cost is outweighed by the long-term benefits to the plan and to the plan participants and beneficiaries, that should win the day under ERISA. So, and in fact, you could even make the case that if you bought all just low-cost investments, that's a breach in of itself if the performance is not there. So, I think without a doubt, it's always in the forefront of plan sponsors' mind is fees, and as well as it should be. But that doesn't mean that there's no case to be made that paying more is a good, it is a good idea under the right circumstances. If it's going to help the participants long term from an investment standpoint. So, I think sometimes we get caught up in it a little bit too much, and we can take a step back and say we can justify it. Liquidity again is an issue. That is something they're going to be focused on. But even today, where we do have sleeves or a portion of assets where they are in more illiquid investments, we can still make it work. I mean, you just have to make sure that you have enough liquidity within the plan vis-a-vis other investment options, whether it's money market funds or something that's more easily traded or just to be traded day to day, things like that. So there are ways to work around that, but that is going to be something in the forefront of their minds because, as I said earlier, their participants are used to what they're used to. So you've got two options. Make it work in a way that it just seems seamless to the participants, or, again, it necessarily doesn't violate ERISA if you take a tack that's different, but then you have to be able to explain it to the participants so they understand, and the plan fiduciary, so they understand, notwithstanding these restrictions, this is still a good deal. And like I said, a lot of funds have a lot of plans have real estate funds that have restrictions on redemptions. Heck, even stable value funds sometimes do in certain market conditions. So it's just a matter of education, as Mike has said a number of times, and I very much agree with, both at the plan sponsor level, the investment consultant level, and the participant level. It's very key from a fiduciary risk management standpoint.
Mike, I want to get you to talk a little bit about how to communicate with this universe. It's plan fiduciaries and institutional consultants. But before we get there, Dave, we were talking earlier about some Department of Labor guidance issued in the past. Anything in that guidance that touches on some of the points you were just making about how trustees can consider these factors and still find themselves on the kind of the defensibility side of the line?
Yeah, in fact, the information letter issued to Pantheon Ventures back in 2020 gives a pretty nice overview of how to structure your analysis as a fiduciary, what a good process is to help establish that you're acting as a prudent fiduciary in making those selections. So I think that is something to point to. Also, I will point out that recently, the Intel Corporation successfully defeated a lawsuit which basically alleged that they violated their fiduciary duties by including too many alternative type assets within the funds that they made available under the plan. It's a huge plan, so a lot of those were custom funds. The court said basically including these funds doesn't automatically violate ERISA. And it really comes down to They looked at the process that the fiduciaries made or engaged in at that time of making the selections. And yeah, for a period of time, those funds underperformed because that asset class, some of the alternative asset classes, did in fact underperform compared to the public markets. But again, it's a long-term play. Normally, that's right. Things are correlated. So if public markets are up, a lot of alternative assets are down. But then you later on, public markets go down and they go up, and that's why they're included in defined benefit plans. So it makes total logical sense that you would include them in a defined contribution plan as well. So I think that Intel case is a good one to look at as well.
Great. Mike, I want to get you to talk a little bit about the conversation that I think David's referring to, which is between a sponsor, either of the vehicle or of the strategy, and the fiduciary or the fiduciary's experts at the consulting firm. But when you're answering that question, what that conversation looks like and what's talked about and how does it really go forward, are there going to be issues that the folks who are bringing assets that haven't been investable for a lengthy period, such as cryptocurrency, for example, is there going to be an issue on just the length of track record that sponsors in this space for some of the newer assets that are coming into our marketplace are going to have in making their case to the fiduciaries and their experts?
Well, John, when you look at the process, it's truly an institutional process with multiple parties involved with defined contribution plans. You have plan sponsors, you have institutional investment consultants. With the plan design and investment menu construction and investment menu selection, these aren't time periods we're talking days or weeks. We're talking an RFP process, request for proposal, that takes several months. The plan design and menu construction, as well as all of the literacy tools, materials, educational materials that need to go around those fund investment options. And so the institutional investment consultant who oversees that defined contribution plan, analyzing alternative investments, looking for the right structure, something like an interval fund that can price daily, fit into a defined contribution plan, which already has daily price vehicles, but also has something that has periodic liquidity, which may mesh with the retirement plan and the defined contribution plan. The institutional investment consulting will be sourcing, screening, analyzing, using tools to measure performance, admittedly in a universe where some of these vehicles may not have, they're newly formed vehicles that may not have a track record. So the look through for an institutional investment consultant, they may have to look through to the actual investment manager for prior track record, and whether they be hypothetical or synthetic track records, as they're called, that would be pursuant to the due diligence of the institutional investment consultant. And so I think that process within itself will take a little bit more time. But I think there are also some fairly sophisticated institutional investment consultants that have experience with alternative investments, because not only have they worked with defined contribution plans, but they've worked with defined benefit plans. And I think to David's point, that Intel Corporation suit, I mean, how many years has that been going on?
9.
A friend of mine, Stuart Odell, used to run that plan. And I remember when he was looking at incorporating, and Stuart now works at an institutional investment consulting firm, but when Stuart was looking at those investments, he looked at all of the alternative investments in their defined benefit plan, which I believe at the time was $8 billion. And their defined contribution plan at the time was $6 billion, so almost as large as the DB plan, defined benefit plan. And he was seeking to mirror what they were doing in their corporate DB, defined benefit plan, and mirror the options in their defined contribution plan. And that was done over a decade ago with Intel. And Stuart's product engineering, and he's working with his consultant on trying to source and screen and find the right investment alternatives, whether they be direct alternative investments or sleeving them into target date funds, which eventually I think that was the solution for the defined contribution plan. And at the time, it was so innovative. I think there are some regulators that really didn't seem to understand how, and now it just seems like it's commonplace. And now from here, we can see more institutional investment consultants working actively with plan sponsors to help educate them on why they need alternative investments. To David's point, you need inflation protection, alternative income, capital appreciation. low degree of correlation. So you can have something complementary to complement your stock and bond portfolios, particularly when you look at volatility that's increased in some of these investments. So you can provide a smoother glide path for the plan participant, provide some inflation protection in their investment options. And I think the alternative investments they have to be packaged right, but you have to have merits, whether it's private equity, private credit, private real estate, private infrastructure, that can tuck neatly into asset allocation models. Because the other thing I may not have touched upon was these institutional investment consultants, there'll be menus and there'll be funds that participants can select from whenever they go to their enrollment to choose investment options for their fund options or package product options within a defined contribution plan. But there are also some of the default options where you can tick a box and say, I want an income model where we have not only public equities and public fixed income package products, but there's also alternative investments, of which 30% gets allocated to alternatives. And there's a sleeve in private equity, sleeve in private credit, a sleeve in private infrastructure, and so on. So there's an income option to check the box, a downside protection option, and then maybe there's a growth option. We've seen that within some of the menus that are being developed, in which they can allocate 30% to alts, and in an income model, you're seeing sort of 7-8% in infrastructure, 9% in real estate, and they can dial up the more income-oriented alternative investments. Conversely, in something like growth model, where they dial up a little bit more private equity exposure, and they dial down the income-oriented exposure. So I think there's a way to provide customization as well as a template that may work for all parties involved.
Mike, that's excellent. And I appreciate that insight. I want to thank you both for the time you've taken to be on this webinar today. And I want to leave our audience with answers to the following question from each of you. And Dave, if you don't mind, I'll start with you. There's been some suggestion that this White House executive order would lead to a world in which defined contribution plans look like defined benefit plans. So from where you sit and just putting your best guess or your best attempt to read the tea leaves or look at a crystal ball, do you think that in some reasonable, near future, you'll see that confluence of exposure and type of vehicle that the defined benefit world has long grown accustomed to in the defined contribution world? Or do you think that there'll still be differences in how they access a lot of the asset classes that make up the world, everything from traded to private? So if you don't mind, let this be your final thought, and thank you again for your participation today.
You're welcome, John. It was a pleasure to be here. And well, I think we certainly will see a trend where defined contribution plans will start investing more in alternative assets. But I wouldn't go so far to say is that it's going to look like a defined benefit plan. I mean, I've seen defined benefit plans with substantial allocations to alternative asset classes, and there's good reason for that, because it's a different funding strategy. You're funding for the long term. Liquidity is not nearly as much of an issue. They just operate the plans operate very differently. So while I certainly would see a trend moving towards these asset classes in the defined contribution space, I still think we're going to still see them run in a lot of ways very similar to the way they are now, which is going to require then the alternative asset managers and folks that they work with to kind of adapt to that system, because that's what the plan sponsors and participants and beneficiaries are going to demand. But that's not necessarily a bad thing. I think there is a place for them in this world. There always has been, and I think we're headed in the right direction with the Department of Labor, hopefully soon supporting those kinds of efforts.
Well, thank you, and thank you again for coming on today. Mike, same question to you.
I think what we're seeing is the door to private markets in defined contribution plans is opening, but it's the pooled products with transparency and periodic liquidity that are walking through the door first. Interval fund managers, they're not just observing a shift, they're building vehicles to make it real. And so I think as we keep this conversation going, And as products are built responsibly, those will be the ones I think that will benefit from an emerging trend. And admittedly, it's a marathon. It's not a sprint. You know, whether we choose to run at a 6-minute mile pace or a 10-minute mile pace is entirely up to the plan participants, the institutional consultants, the fund sponsors, that kind of thing. But I think success is going to take many factors. And I think the right opportunity will take time for formation. And again, I would leave you with financial literacy solves a lot of these things. And I think it's of paramount importance to stress financial literacy and alternative investments. That's the first thing that's got to happen before we can even see any meaningful growth within the alternative investments within defined contribution plans.
That will be then the last word. Thank you, Mike. Thank you, Dave. Sure appreciate everyone's time and attention today. And visit us at adisa.org for more resources and look for us to be participating in this dialogue, fascinating dialogue going forward. Thanks again.